Alright, Chapter 13, Mortgages and Finance. Essential matters to learn over this chapter. Mortgage loan is a pledge of property to security for the debt, with a mortgage loan combines two contracts. One, a note, which is the debt. Two, the mortgage derived from the Latin deed pledge, which pledges property to secure the debt. The borrower gives the mortgage pledge to the property as a security for the debt. Two, the lender. Borrower is the mortgage. The lender receives the mortgage, and this is a mortgagee. In the title theory state, lender holds the property, and in theory states the lender has the lien on the property. Type of the mortgage include alphabetically. Adjustable rate, interest rate change with the regular intervals, such as each year with the total rate of sum of the index rate plus with the margin caps or the maximum change allowed in the rate. Caps can be annually limited to the life of the loan over the limits. Bi-weekly payments are made every 2 weeks. Two payments equal the same amount with a 1 month payment. It would be because there are 26 2-week periods of the year. Total annual payment amount is similar to the 13 months payment. Accordingly, with the loan amortized more quickly than monthly payment loan. A blanket includes more than one parasol and reset. Bridge loan, you have to cover deficiencies during the period of the construction loan and permanent loan budget. Payments include principal and interest, property tax, and insurance. Should tell mortgage personal property not to real estate serve as collateral. Conforming loan specification that would allow the person for the FNA construction use the money to build with a high risk because of the uncertainty completion of the construction sale with the occupancy of the property. They carry high rate interest rates. Conventional loan and Federal Housing Association insured with the Veterans Affairs guaranteed the loan to value of the ratio 80% of private mortgage insurance may be required by the lender. FHA, insured Federal Housing Authority, U.S. Department of Housing and Urban Development. Flexible payment interest rate charges bring up change in the remaining term instead of changing the payment account. Gap loans use a shortfall of the construction loan and permanent loan amount used to purchase a house while waiting for sale of former house. 13, graduated payments low in the early areas increase where they can be fully paid interest and amortized principal. Home equity loans, junior mortgages, limited amount of the equity of the home. Land contract for deed. Loan for seller who does not transfer title until the final payment is received. Open or open-ended. Most principals can borrow at a later date with loan agreement package. Collateral pledge includes real estate, personal property such as furniture and appliance. Purchase money mortgage loan from the seller to the buyer. Seller provides the title at closing. In reverse annuity, lender pays borrower a lump sum or a monthly amount. Borrower must be over the age of 62. Substantial equity in house. Swinging loan, intern loan with the temporary needs of the funds to buy another property. VA guaranteed, lenders guaranteed against loss up to the present amount by the U.S. Department of Veterans Affairs. Wraparound loan, a second mortgage that overstates its balance by including an existing first mortgage. Frequent use provision, mortgage related terms alphabetically. Amortizing payments will exceed interest of difference reducing principal for amortized loan will be paid with zero balance at the end of the amortization period. Assumption, agreement by the purchaser to become liable to repay the existing loan owned by seller property with that purchase does not relieve the original borrower whose property sellers of any obligation. Balloon payment, a large final payment of loan. Debt coverage ratio comparison of the net operating income over the property to required debt service for more income producing properties. A ratio at least 1 to 2 inside the prudent lender. Deficiency judgment following the foreclosure sale, unpaid amount due from the borrower when the foreclosure sale does not bring enough money to full repay the mortgage balance plus expense foreclosure fee. So FICO score used by mortgage lender to evaluate applicant ranging from 30 to 300 to 850. A score above 660 qualifies as a prime loan. First mortgage, one required for the first against the property required at the courthouse. Foreclosure, involuntary sale, lender of the certain borrower default of the foreclosure process must apply with state law. Jumbo, loan for an amount that exceeds the FNMA guidelines. Junior, a mortgage that lower in priority to the first mortgage. Loan to value ratio, percentage ratio, mortgage principal compared to the property value. Negative amortization, monthly payment is less interest, principal balance is increase. Novation, a three-party agreement whereby one party is substituted by another. Origination, creation, mortgage loan. Mortgage originators include mortgage banker, brokers, lending institution, permanent mortgage, a mortgage that is not scheduled to be repaid within the next 10 years. Prepayment privilege and penalty, right to pay for the mortgage prior to the maturity. Mortgage may provide for the penalty with the AAA or the Federal Housing Authority. Loans cannot have penalties, so they prepay without penalty. Primary mortgage market participating originating mortgage loans. These include mortgage bankers, brokers, lending institution, priority order payments, such more satisfied mortgage, other liens in the event of the foreclosure sale. 18 19 private mortgage insurance, PMI insurance, partial repayment leaders of the default, eventual non-VA, non-FHA home mortgages, refinancing prepayment of mortgage loan by substituting another mortgage loan. Refinance is often referred to as reduced interest rate, extra cash by increased principal. Second mortgage, one recorded with the county courthouse after the first mortgage. Below the first mortgage in priority claim, the amount owed by the second mortgage may be greater and less than the amount owned on the first mortgage. Secondary mortgage market refers to the purchase of existing mortgage. Fannie Mae, Freddie Mac are largest participants. Short sale upon default mortgage. The lender may agree to sales prices that is short, less the amount owed to avoid foreclosure. Subject to agreement by purchaser, become liable to make punishment payments. Existing loan and property purchase that not become liable for the entire primary principal balance does not relieve the original owner of obligations. Subordination agreement of the loan will not move on priority even if the mortgage have higher priority is paid off. Subprime loan underwritten with less prime qualities such as low bar FICO scores. Borrower with low FICO scores, often below 620, may still be eligible for loan. Likely required to be a subprime loan. Term, period of time, loan maturity. The term may represent full amortization time by early with a balloon mortgage. Mortgage participants include alphabetically commercial banks, institutions acceptable to deposit originating mortgages, construction loans, additional mortgage businesses, and commercial consumer loans, federal home loan mortgage corporations, Freddie Mac, or FHLMC, a government-sponsored enterprise that performs the same function as FNMA, Federal Housing Administration, FHA, branch of HUD that insures qualified mortgages. Down payments may be as small as 3%. Federal National Mortgage Association, also known as Fannie Mae or FNMA, government-sponsored enterprise that buys mortgage loans on the secondary mortgage market and does not originate mortgage loan. 5. Governmental National Mortgage Association, Ginnie Mae or GNMA, government agency subsidized mortgage serve low and moderate income home buyers. Mortgage banker, a company that originates, services, and sells mortgage loans. Mortgage broker, a company that originates, sells mortgage loans. Savings and Loans Association, institution accepted deposits originating mortgages. Construction loan, Veterans Affairs Department of the U.S. government agency with guaranteed loans made to eligible veterans up to a certain amount. Down payments may be zero. Please study the Fair Housing Law in Chapter 20 and Truth Lending in Chapter 21. Most real estate professionals learn very early in their careers borrowed money is the lifeblood of the real estate business, but because nearly all real estate purchases are made with the borrowed funds, most real estate development construction use borrowed money. Without access to such funds, the aspect of the real estate business dry up quickly, and solicitation activity has occurred several times during the period of the tight money when interest rates are high and loanable funds are scarce. Importance of borrowed money. Several reasons for the dependence of the borrowed money with the real estate business. Perhaps the most significant reason is the real estate expensive. Real estate is expensive. The modern home is more than $100,000. Apartment project, office building, shopping complex alike, with the often costs in millions. For a careful approximate 66% of American families that own their own homes could do so if they had not been able to borrow a significant portion of the price at a higher purchase at time of purchase. Quite simply, very few families have kind of ready cash necessary to buy a home without borrowing. Similarly, very few real estate developers have enough cash that can handle finance completely to the ventures they engage in. Another factor that contributes to the importance of borrowed money in the real estate business is the real estate is very good collateral for loans. It lasts a long time, so it can be used up the backup loans that have the long repayment terms, such as 15-30 years. Typical most home mortgages that enable the real estate owners to spread the cost of their assets over the long paying term so that they can afford expensive units, as well as spread the payment over the time they expect to use up the assets. Real estate investors like borrowing money to buy a real estate because it gives them leverage. A simple example, suppose someone buys an apartment complex costing $5 million, putting up $1 million of his own money, getting the mortgage for another $4 million, in effect getting to control a $5 million property, but has used only $1 million to do it. Borrowing is able to considerably more than if used on his own money. If he is with choice of the real estate to buy, he improved his investment profits considerable by borrowing. Mortgages and notes. Financing real estate. Two important documents are employed. Loan evidence that in which the note or bond and the mortgage which is pled property security of the debt. The simplified sample of the note and mortgage is shown on the next page. Since borrower give the note with a mortgage over the lender, borrower is the mortgager, lender is the mortgagee. The suffix or always signifies the giver, and e describes the receiver. A mortgage note. All the both contract provisions agreed upon that have been written either in contract so long as the provisions are legal. Essential elements for the note: A, promise to pay, and B, a fixed or determined time. C, a certain sum of money. D, a payee or bearer, and E, signed by the borrower. Title and lien theory. Mortgages are also called trustee several times, viewed either with a transfer of property to the lender, title theory, or creation of a lien. Lien theory. Title theory holds that the property is transferred to the lender subject to return of the property borrower upon payment of the loan. Lien theory holds that the mortgage gives the lender a lien over the property but no title to the mortgage. Loan classification. Mortgage loans usually classified described according to particular provisions. Several types of mortgages, their provisions described below. VA mortgages, also known as GI mortgages. VA loans made private lenders eligible veterans. VA guaranteed loan projects lenders against the loss of payments not made. VA guaranteed loans can be used to pay a home, either existing precaution premium residence or refinancing existing loan. Benefits of VA guaranteed loan. Equal opportunity qualified veterans to obtain VA loan. Reusable, no down payment unless required, but the lender purchase price is more than the certificate reason value of property. No mortgage insurance. One-time VA fund fee that can be included in the loan. Veterans receiving the VA disability compensation are exempt from the VA funding fee. VA limits certain closing costs of veteran pay. Can be assumed that the qualified person minimum property requirements to ensure the property is safe, sanitary, and sound. VA staff decides to assist veterans who become delinquent on their loan. Who is eligible? Generally, the following people are eligible: veterans to meet length of service requirements, service members active duty who are serving the minimum period, certain reservists, National Guard members, certain surviving spouses of deceased veterans. Key understanding criteria: no maximum debt ratio. However, the lending must provide with a compensation factor. Debt ratio is over 41%. No maximum loan amount. However, the VA does limit the guarantee. The veteran can borrow up to $417,000 without down payment in the most counties. Find out the limit in any of the county by visiting benefitva.gov. Home loans publish residential income guidelines to ensure veterans have capacity to repay the obligation with all the account or living expenses. No minimum credit score required. Instead, VA requires lender to review the entire loan profile to make lending decision. Complete VA credit guidelines are published in Benefits VA.gov. Warms PAM 267 ASP. Maximum potential guarantee on the loan are 2014 calculated. The Federal Housing Administration mortgages. Federal Housing Administration mortgages with the Department of Housing and Urban Development. Many programs help to provide housing and insure the single-family and multifamily homes, nursing home mortgage loans as mobile homes, some other properties. Since Section 203B is one of the most popular federal home housing administration programs, the purpose of 203B is to provide mortgage insurance for a person to purchase, refinance, principal residence. Mortgage loan is funded with a lending institution such as a mortgage company or a savings or loan association. Mortgage is insured by HUD to be eligible in 203B. Mortgage the borrower must meet the Federal Housing Administration credit qualification. Eligible properties 1 to 4 unit structure. Borrower may borrow up to 97% of the purchase price, may include upfront mortgage insurance premium, mortgage principal. The borrower will also be responsible for paying annual premium. More information program is at HUD offices. Conventional mortgage conforming it when jumbo. Conventional mortgage are loans that are neither guaranteed by the VA not insured by the Federal Housing Administration. Generally, they are fixed rate, fixed principal for interest payment type. 2015, the maximum amount of single family house conforming with the FHLMC or FNMA guidelines was 417,000. Loans above the amount are called jumbo. Jumbo mortgages are insured privately. Private mortgages insurance. Normally on conventional loans within 80% of loan value, the ratio of the private mortgage insurance is required. However, if the loans are more than 80% lower appraised value of the mortgage property or its sales price, the lenders of the private mortgage insurance in which is paid for the borrower, the conventional loans may be as such as 100% of the purchase price, provided that the private mortgage insurance covering the loan amount is excess of 80% of the loan value to be purchased. A practical matter, however, the cost of the private mortgage insurance makes the loans much more than 90% loan to value expensive. It is not to be worthwhile. Alright, subprime mortgages, loans that do not conform with the FHLMC or FNMA guidelines may still be available to typical higher interest rates. For example, many people without adequate historical credit record may arrange a loan called a subprime. One case applies to those who have recently become self-employed, cannot meet FNMA and FHLMC historical self-employment and earnings. Lenders may offer a loan, but because of the conforming loan, there may be no marketable FNMA and FHLMC, therefore carry a higher risk and a higher interest rate. Or the FICO score, a fair insurance company has developed a credit rating system most lenders heavily in deciding whether to offer the loan. This system is called FICO. You can get a better understanding of it from FICO.com. It scores credit worthiness to a scale of 300 worst and 850 the best. Most credit business trends use Experian, Equifax, apply FICO. Some lenders will extend typical underwriting criteria for those with the highest FICO scores. Purchase money mortgages, sometimes after a seller provides financing with a purchaser, accepting the mortgage loan in lieu of the cash or all the part of the purchase price. A mortgage of the type whether the seller accepts a mortgage loan is called the purchase money mortgage. Seller effectively gives purchase money to the buyer. Construction loan and permanent mortgage. Construction loans are used to builders, developers, improve the land. Construction advances are permitted with the construction progress. The commercial property is complete with a permanent loan is used to pay off a complete construction loan. Construction loans on the single-family homes usually continue on until residence is sold. The occupancy arranges permanent financing. Word permanent is used with the real estate financing misnomer. Permanent mortgage loans seldom have terms beyond 30 years. Most will be repaid before half the term. Although conventional wisdom of the typical mortgage loan and misunderstanding 12 years recent experience has shown shorter-term declining interest rate have encouraged more refinancing. Term loans, amortization, balloon payment loans. Term loans requires only interest payment to maturity. If the end of the maturity term and entire of the principal balance is due. Amortization loans require periodic payments called the P&I interest. P&I payments, a payment was greater than the interest charge of the period above the principal amount with a reduced the least slightly each payment. Amount of the month payment of amortization loan is calculated but adequate to retire entire debt over the amortization period. Balloon payment loan requires the interest of some principal to be repaid during its term, but the debt is not fully liquidated upon the maturity. There is still a balloon to repay. First and junior mortgages. Mortgages must be recorded at county courthouse. Given the notice of existence, mortgage loans are recorded in the courthouse. Again, the property remains first mortgage until the fully paid off. The event of default and full foreclosure, the lender who holds the first mortgage receives the payment in full before other mortgages. The lender receives anything. Any mortgage recorded with the first mortgage is called a junior mortgage. Junior mortgage are further described as second, third, and fourth, so on depending upon the time they were recorded in relation to the other mortgages on the same property. The earlier the mortgage is recorded, the earlier the mortgage claim is in foreclosure action. Subordination clause. Mortgage may prevent it from moving to a higher priority given priority to liens that are arranged later. Home equity lines of credit. Home equity line of credit is like with a second mortgage loan, except if the borrower does not have to draw down all the money at one time. The type of the loan will be issued with the borrowers anticipate that they will need more money in the near future, but it need not immediately. Setting a home equity line can be applying credit card, it can be like applying for a credit card. However, because the second mortgage is involved with the process, including appraisal of the property, application fee must be 2% of the line of credit. That some of the lenders may reduce, even waive this fee. Some of the plans are charged annual fee that encourage the borrower from the use of the line once it has been guaranteed. Additional May plans require that the borrower to take minimum amount of the loan, which is granted. Home equity lines of credit offer flexibility to waive access to the home equity, thereby financing period needs tax deductible interest up to $100,000 home equity loan. Generate tax deductible home housing interest where personal interest is no longer deductible. Borrowers may tailor a plan to the way that they handle the payments and control up the line of checks. Good for infrequent large withdrawals. Credit cards for frequent smaller withdrawals. Budget mortgages require homeowners to pay for the additional monthly interest principal payments 1/12 of the estimated taxes and insurance. The escrow account, also called the impound account, the mortgage reduces the lender's risk of the lender is thus assured of the adequate cash available. The annual tax insurance bill comes due, but the payment is abbreviated PIAT, principal interest tax insurance. Package mortgages, in addition to the real estate, may include appliance, drapes, and other items. Personal property amount loan. The lenders tell the exercise more control over the borrower's monthly obligation. Borrowers able to spread payment such that the item's lengthy period. Chattel mortgage. A chattel mortgage is a mortgage on personal property. The property may be a car, boat, furniture, or like. Blanket mortgage covers more than one parasol real estate. releases provisions usually included to allow individual parcels to be released from mortgage upon payment of part of the property principal. Open-end mortgage. Upon this type of the mortgage, initial balance increase that is in full fund remains upon additional amount homeowner may buy and place need extensive repair work. Initially pay $125,000. Initially getting $100,000 loan. The balance may be increased, say $200,000 repair work process. Flexible payment mortgage and ARM payment changes periodically based on certain interest rates. Flexible payment loan change if the interest may not be changed for the permanent immediately instead of the maybe payment caps to the limited change of the payments instead of the payment rising to pay the higher interest requirement. The principal balance increases. This is called negative amortization. A wrapped around loan. This is really a second mortgage that includes the existing first mortgage and balance above the commercial property is worth $1 million. It has $650,000 in first mortgage loan interest rate. Say 4%. Lender may be willing to advance $150,000 at 8% due form second mortgage, but there are negative characteristics associated with the second mortgage. So potential second mortgage advance of $150,000 in cash loans at $750,000. Wrap up to be $600,000 plus $150,000, $750,000 interest rate with a wrapped around 6%. Borrows wraparound lender or payment of $750,000. The wraparound lender pays the first mortgage payment. The first mortgage prohibits the second mortgage. Wraparound may also be prohibited. A swing loan allows the borrower to swing a deal so both of the homeowner is buying a new house but hasn't sold the old one. The swinging loan provided the bank a short term to use as equity for the new house. The loan must be repaid when the old house is sold. Variations include bridge loan, gap loan described below. Bridge loan is a short-term loan, the covered period for the construction loan with a permanent loan with maybe the time lag during which short-term loan is needed. Gap loan is used to fill the shortfall under certain conditions have been met, such as an occupancy percentage rate of the office building. Permanent financing may have the floor amount payable for the construction complete higher amount when the occupancy reaches a certain level. The gap loan funds the difference the occupancy reaches a specified level. Construction loan. A construction loan constructs costs of the advancing money to step the project of the development. Generally is considered a high-risk company with a high interest rate discount points and fees. Underwriting is more difficult for a proposed project than for one more than fully occupied. The construction lender does not want to advance more than is put in projects, so the loan is made in increments. When the land is purchased, streets, utilities, installed, foundation, framing, roofing, and so on, before providing construction loan, lender generally requires a buyer to commit the permanent financing into the income property is built. For subdivision loan release provisions, all parcels remove collateral, so lots may be sold with the released lots require payments against the loan. Home equity loan for households that its house is rich and cash poor. Home equity loan may be the tempting way to finance a child's college education, medical bills, and other purposes. The home equity loan is likely to be a second mortgage, but it carries a lower rate than the other types of consumer finance. Home equity line of credit can be discussed privately. Set land contract. A land contract, also called a contract of deed, installment sale contract. Title does not pass until the final payment is made, with the often used the financial recreation resort property for buyers of poor credit ratings. Sale leaseback. A lease and loan share many of the same characteristics. So a lease can be structured to be like a loan. Instead of borrowing and the raise the loan, repaying the loan, one can sell the property, lease it back for a long-term 25 to 30 years. Still generates cash like borrowing a mortgage loan. The rental payments for like mortgage payments at the end of the lease. Therefore, the may purchase the option small amount of the property. Uses sometimes method ranging 100% finance control property without taking the title to the as an owner. Mortgage repayment. These for decades the only one mortgage repayment method was available to home loans. Fixed interest, fixed payment, amortization on low loans. Interest rate was always the same. The monthly payment always the same. When all scheduled payments had been made, the loan balance was paid in full. At the beginning of the 1970s, however, the variety of the other methods into the mortgage bank today, the most popular loan, fixed rate mortgage, and adjustable rate mortgage. Each of them have several variations. Fixed rate mortgage, most popular modern mortgage instrument. It features the interest rate that does not change. It is fixed over the life of the loan. Fixed life loans can have up to 30 years or even longer in certain restricted government subsidized program. Most popular term, however, is 30 years, followed by 15, 20 years. Typical FRM monthly principal interest payment remains the same throughout the long term. By the end of the term of the loan has completely amortized. It's repaid with the lender. However, there are some people that plans in which monthly payment is not always the same. The most commonly graduated payment, mortgages, balloon mortgages. Graduated payment mortgage, or GPM, is designed to also allow the relatively low month payment of the first year of the loan payment and is increased with the sum of the non-permanent percentage each year until it becomes high enough to fully amortize payoff of the loan over a remaining term. Typically, the final payment level will reach after 5 as many as 10 years. Unpleasant feature most of the graduated payment and mortgage is a negative amortization. In early years, loan principal amount actually goes up instead of down at first because payments during the first 3 to 5 years aren't enough to pay interest on the loan. Upon paid interest is added to the loan amount, which keeps growing until the payments even eventually become high enough to cover the interest. Balloon market feature for the responsible monthly payments, but terms too short to allow the loan to be fully paid. Therefore, the end of the term of the large final payment balloon is due. Typical arrangement is the borrower for the making payments for the roof of the loan has 30-year term. However, the 10 and 15-year loans come due, and the entire unpaid balance must be paid. Some balloon payments and loans call for the interest payments only. There is no principal reduction for the maturity. Or adjustable rate mortgages features an interest rate that changes every so often. The change of the interest rate also means a change of the amount of the monthly payment. Adjustable rate mortgages, first introduced in 1970, did not become popular borrowers until the 1980s, which several modifications have been introduced to help overcome the consumer reluctance. Amortized rate mortgages were first offered. Wide variety of terms and conditions were available now. Amortized rate mortgages have been fairly standardized for the few popular versions. The main features such as the periodic adjustment interest rate based upon some index rates, or both periodic lifetime caps interest rate. The period of the loan frequency of the adjustment occurred with a common period of 6 months, 1 year, but longer than 3 to 5 years gaining popularity. Today, most amortized adjustable rate mortgages have interest rate adjusted every year. Interest rates are adjustable arbitrarily, but they are based upon index rates. Adjustable rate mortgages contract specific indexes used in the margin. Each time the rate is adjusted, the margin will be added to the index to get the new rate of the adjusted rate mortgages the following period. The cap limits of the change of the interest rate of the period. Cap limits the amount of the change in for one period. Limited caps provide upper, lower, and interest rate limits for the implied for the entire life of the loan. Most popular cap arrangements are 1 and 5, limited largely to the federal housing and VA loans. The 2 and 6, first number to the period cap, second life cap. Lifetime cap and annual adjustable rate mortgage with 2 and 6 caps were adjusted every year annually by no more than 2% points for the periodic cap, above or below the previous year's rate. Over the life of the loan, interest rate can't rise more than 6% of the points in the lifetime cap above the original rate. Adjustable rate mortgages are popular with lenders who do not want to get stuck in low interest loans in a period of rising rates, but difficult to sell with the borrowers whom are willing to risk the rise in interest rates would increase their loan payments. The mortgage industry addressing the concern with a variety of features, concessions. Adjustable rate mortgages loans, the most popular effect for the convertibility leaser rates. Convertible feature, which is not automatically part of the adjustable rate mortgage loans, allows the borrower to convert adjustable rate mortgage loans to the FRM fixed rate mortgage loans at some time in the future, easily 3, 4, 5 years after the loan originated. Typically, a fee with up to a half or 1% of loan amount charge conversion. People with convertibility with the loan does not have to be in an adjustable rate mortgage forever. The borrower feels safer with an adjustable rate mortgage because of the conversion privilege. Teaser rates usually are initial interest rate, very common adjustable rate mortgages with annual short adjustment periods. Interest rate with attractive low for the first year or two. Adjustable rate mortgages translate into low initial payments, thus into genuine money saving for the borrower. Teaser rates can either be another useful effect. Lifetime caps apply with the initial loan rate. The maximum interest rate of the loan will relatively low as well. Teaser rates are typically 3 or more percent below the current fixed rate mortgage interest rates. For example, fixed rate mortgage loans available 4% interest, 30 years mortgage. The teaser rate at 30-year annual adjustable rate between 2 and 6 lifetime caps probably will be around 1%. This would, in the lifetime cap, 1% plus 6%, 7%, even if you originated but the interest rate were raised by a full 2% annual cap. Second year rate at 3% instead of a full point less original fixed rate mortgage. To illustrate, a 30-year fixed rate mortgage at $500,000 at 4% interest monthly payment would be roughly $2,400. The adjusted rate mortgage at $500,000 with a 1% teaser rate would require a monthly payment of $1,688. First year maximum payment, 3 interest 3% interest, $2,091, and with second year adjustable rate mortgage borrowed with more than 9,364 years ahead of the first year, another $3,500 ahead on the second year, total cashing $12,900 over the first 2 years. This money in pocket provides many borrowers with a strong incentive to choose an adjustable rate mortgage, particularly with all those convertible features. Adjustable rate mortgages, longer adjustment, 3, 5, and 7 years become more popular. If they have a teaser rate, these rates are more closer to fixed rate mortgage rates of 1 to 1.5% less than most. Periodic caps loans higher, although lifetime cap about 6%. This is common. Others, reverse mortgage. Here, lender makes payments to borrow, gradually advancing money. Typically, the elderly homeowner, the amounts advanced plus interest become the principal of the loan. Payments for the lender are deferred on the sale property. The death of the homeowner, time when the balance owed approaches the market value of the home. Reverse mortgage can be arranged whereby the money borrowed against the home used to purchase annuity contract will pay for the homeowner of the life. Homeowner pays the mortgage interest for the income with annuity. Primary borrower must have at least 62 age, qualified with the Federal Home Administration. They are likely to be used with people who are housed rich but cash poor. Biweekly mortgages. Here, lender figures the monthly payment of a 30-year amortization loan requires half of it to be paid every 2 weeks because of the 26 2-week periods a year. This is equivalent to paying 13 months per year. Result in loan is retired at 18 to 22 years. However, the borrower who paid every 2 weeks, such as mortgage, will fit the budget well. However, it will not appeal to those who paid monthly. Primary mortgage market. It consists of the institution originates mortgages. The mortgage can then be sold as called a secondary mortgage. Savings loan and associations originate residential mortgages in the United States. Most sell loans secondary market. Commercial banks originate many residential mortgages. They are more active, however, than construction loan field and any other types of lending. They have a great deal of latitude in types of activity that they engage. Strict limitations imposed to each type. Mutual saving banks have no stockholders that operate with the benefit of the depositors. Some of the investing residential mortgages. Life insurance companies invest a relatively small amount of total asset residential mortgage loans. They are quite active permanent mortgage loans, income producing property, including apartments, shopping centers, and off buildings. Mortgage companies, also known as mortgage bankers and mortgage brokers, most common source of the home mortgage of the originating almost 2/3 of the residential mortgage. However, their business do not lend their own money. They are not a financial institution. Rather, they originate and service home mortgage loans on the behalf of the large investors, insurance company, banks, personal pension funds, and and mortgage bankers receive a fee originating loans and fees for the servicing them, collecting payments, holding escrow, dunning late payments, and so on. Mortgage partners originate loans that do not service them. The secondary mortgage market. The Federal National Mortgage Association, FNMA, or Federal National Mortgage Association, Fannie Mae, is a federally chartered corporation. August 2008 placed government conservatorship because of the mortgage crisis. Future is known at the time, but it does not make with a direct loan. Homeowners rather purchase it. First mortgage loan may be originated by the mortgage banker. Second mortgage market, the Federal National Mortgage Association thereby adds liquidity to the mortgage investments, making mortgage more attractive investment. Federal National Mortgage Association presently owns significantly percentage of all residential mortgages. Federal Home Loan Mortgage Corporation, or Freddie Mac, is previously owned by the corporation. Likely the Federal National Mortgage Association buyers, mortgage secondary mortgage buyers, inventory savings loan association, commercial banks. It also sells participations in pools of mortgages like Fannie Mae is placed under governmental conservatorship. In August 2008, is featured of the uncertain. Government National Mortgage Association, or Ginnie Mae, is the U.S. government entity that encourages low-income housing guarantee packages consisting of federal housing, VA loans. Federal Home Administration Agency, which as regional banks provide financial purchasing operation, farms, rural homes, guaranteeing loans on such properties made to others. Lending criteria. Institutional lenders perform process underwriting the purpose of the asset of the risk making loans, looking at the property of the borrower as the property lender typically arranges an appraisal of the cost to be paid for the borrower, which will provide information about the property's value, location, market condition, including comparable sales. Lender will give the credit report with the borrower, financial statements, and letters from the employers concerning the salary, term, and employment. The prospect for the continuation of employment of the lenders will vary for the bank accounts, other assets, borrower, as well as liability. The conventional plan. For a conventional loan, single family home lender will normally require 20% of the down payment. There would be a loan-to-value ratio. 80% of the borrower seeks a greater loan-value ratio. It would require to give a private mortgage insurance up to 90 to 95% loan value. May be obtained. The duplex 4-unit property large down payment is 25% normally required. Lenders have certain guidelines to follow with a truly marketable loans. This is the loan that can be sold with the Federal National Mortgage Association, or FHLMC. This is called the confirming of the loan, when lender will be qualifying ratio housing payments to gross income at 28% ratio, with totally fixed payments to gross income at 36%. For example, Anderson's earns $10,000 per month. Maximum housing payment that would be allowed at $2,800 per month, including principal, interest rate, tax, insurance. When payments on other long-term debt, such as car loans, considerable, the maximum allowed would be $3,600, or 36% of the guidelines exceeded the applicant with a FICO score. Many lenders will offer non-conforming loans of those who don't qualify the loans who won't conform to FNMA, FHLMC guidelines. Higher rate interest is charged, but they may allow the marginal borrower to purchase homes. Desired non-conforming loans include jumbo, subprime, and alternate. With income-producing property, the lender will also look at the debt coverage ratio. If the operating income proceeds to exceed the debt service and comfortable margin, that is 25% more so with the debt services leverage rate, 1.25 times the net operating income may be required. When considering a loan in stock cooperative apartment, lenders will consider the risk of existing sold-out development, at least the risk of one of the be built, converted from rental agreement for those developers sponsor filing, and the stock's attorney general may offer the close with the likelihood of success. Mortgage loan discount points. 1 point is 1% amount of the loan. Some mortgage loan charges expressed for the term points charges either the fees for the discount. Typical fees expressed in points are originate fees or conversion fees. Adjustable rate or fixed mortgages, see page 240. The prepayment penalties or so on. The actual dollar amount such fee depends on the dollar amount of the loan involved. For example, the new mortgage has loans originate fees. Usually a fee is 1.1% of the loan amount. For example, for a loan of $100,000, the fee is $1,000. For a loan of $7,500, the will be $75,000, $750, and so on. Discount points or something else, although they are to express the percentage loan payment, the discount of the paid origination in order to produce the interest rate of the loan. You can think of the discount somewhat interest paid in advance, depending upon the amount of discount required. The lender would offer a variety of the interest rate of the new mortgage loan. For example, the menu interest rate of the might be 6.5, These means the lender will offer an interest of 6.5, no discount duty, usually called the par, 6.25 return payment at 1.25% loan amount. 6% in return, 2.5 point discount loan from the menu borrower. Interest rate 6.5. It does not discount paid 6.25. Paid in advance 6% advance payment. That says $2,500 would. Anyone paid discounts. Actually, many of the borrowers don't. However, the sellers often do variety of reasons, usually concerned with making sale more attractive than buyer. Discounts are either the buy-downs of an association trees or interest rate of the buy-down substitute with an initial charge of the interest later with the loan. More often, you either provide unusual loan interest rate during the early period of loan. For example, if the normal rate interest 7%, lender may offer the buy-down for a fee of about 5.5% for the loan amount. That will give the loan an interest of 5% for the first year, 6% in the second, 7% for the third. A third-year interest rate will be 7% for the rest of the loan period. Prepayment penalties and privileges. Nearly all home buyer mortgage loans allow buyer to pay off the principal balance without penalty at any time of the commercial property. Mortgages require penalties such as 3% of the outstanding balance. Early debt retirement penalty that diminishes over time. Acceleration clause states that the full principal balance becomes due upon certain default. One or more payments of past due depending on the agreement. Entire loan becomes due. It's common for residential mortgage to have a due on sale clause. The due on sale will cause the loan to become payable when the property is sold, even when the loan is not in default. Alright, loan assumption. Property offered with the encumbered with the loan bearing a low interest rate, which makes it attractive for the real estate purchase. The buyer may sell it with the equity with the difference between the property value of the free of the clear of the amount of the debit. Then you assume the loan, the purchaser becomes liable. The loan required payments, the original hour Borrower, however, is not automatically free of the obligation. He also must ask the lender for an innovation, which serves as a release from the responsibility to then substitute the new property owner as sole debtor. In the absence of an innovation, the lender may look at the property with both the original borrower and subsequent purchaser for the repayment. Rather, assume the loan purchaser may agree to take the property subject to a mortgage loan. In doing so, the buyer acknowledges the debt does not become her personal liability. In event debt default stands to lose no more than investment. Alright, usury, every state law prescribes maximum permitted interest rate, charging high interest rates. Permitted law by considered usury penalties usually differ widely from state to state. Or estoppel certificate is a statement that prevents issue of those asserting different facts at a later date. For example, the mortgage originator may wish to settle the mortgage loan. They right to collect payment due another. Loan purchase may ask for the estoppel certificate whereby the borrower states so the amount he owed later. The borrower is stopped by the assertion that he owed less at least less at the time signed with the estoppel certificate. Releasing mortgages, formats of the property must be released at our satisfaction. P. The document lender states the loan is paid off. The lender releases the property for lien, parcel, land release of the part of the mortgage property from the mortgage, usually upon payment for the debt. Postponement of the lien that is not satisfied but subordinate, meaning that it assumes lower priority. Foreclosure of the described detail below. Alright, foreclosure, deficiency, judgment, equity of the redemption. Upon the default, the lender may be allowed to go through an authorized procedure known as foreclosure to have the property apply for the payment of the debt should the property sell with a foreclosure for more than unpaid first mortgage loans, plus expense for the foreclosure action. Excess belongs to the junior lender. After the lenders have received the full payment, excess the funds of the borrower is more likely to perceive the foreclosure will be inadequate for the paying the mortgage indebtedness. In this case, the lender may attempt the deficiency judgment from the amount of the loan remains unpaid, requires the borrower to pay the deficiency personally. The deficiency judgment difficult to establish in many jurisdictions. Commercial property mortgages frequently able to negotiable expiatory clauses of their loans. Expiatory clauses can cause loans called a non-recourse, which the clause exists. The defaulting borrower may lose the real estate that he has pledged, but is not personally liable for the debt. The lender may look at only if the property is collateral. Should the property be foreclosed, the borrower has the right to redeem the property, repaying the full principal awarded, known as equity of the redemption, must be exercised within the time period prescribed by the state law. Some states the right must be exercised before actual foreclosure, and others the right remains up to 2 years after such a sale. And that was chapter 13. Chapter 14, Appraisals.